39, that's the number that should make every serious investor liquidate their portfolios immediately. The S&P 500 Shiller CAPE ratio just hit 39, a valuation level witnessed only twice in the last 153 years. The first time was September 2000, right before the dot-com crash that destroyed $5 trillion in market value. The second time is right now, December 2025. And what's coming next could make 2000 look like a minor correction. I've been analyzing market valuation metrics for over 15 years, and what I'm seeing in the current data should terrify anyone who understands how market cycles actually work. This isn't just expensive stocks. This is a systematic repricing of risk that has disconnected asset values from economic reality by margins that defy mathematical probability. When this correction comes, and it will come, the destruction will be measured in decades, not years. But here's what makes this situation exponentially more dangerous than 2000. During the dot-com bubble, only about 30% of Americans owned stocks directly or through retirement accounts. The cyclically adjusted price-to-earnings ratio, developed by Nobel Prize winner Robert Shiller, measures stock prices against 10-year average inflation-adjusted earnings. It's designed to smooth out business cycle fluctuations and provide a long-term perspective on market valuations. When the CAPE ratio exceeds 30, markets are historically expensive. When it exceeds 35, markets are in bubble territory. At 39, markets are in uncharted waters, where mathematical models break down and traditional investment logic becomes meaningless. Let me walk you through the historical pattern that explains why CAPE 39 is a mathematical impossibility that can only end in catastrophic collapse. Because understanding this pattern might be the difference between financial survival and retirement destruction in what's coming next. This is the same four-stage valuation bubble cycle that has preceded every major market crash in the last century. Stage 1. Fundamental disconnection. Stock prices begin rising faster than corporate earnings can justify. Market participants rationalize higher valuations through narrative changes, new economy, productivity gains, technological revolution. Early-stage CAPE ratios move from 15-20 to 25-30. We completed this stage in 2021. Stage 2. Mathematical impossibility. Valuations reach levels that require impossible future growth rates to justify current prices. CAPE ratios exceed 30-35. Market participants abandon traditional valuation metrics and embrace new paradigms. We entered this stage in 2023. Stage 3. Universal participation. Everyone becomes convinced that traditional valuation doesn't matter. Retail investors pour into the market. Professional investors feel pressure to stay fully invested despite recognizing bubble conditions. CAPE ratios exceed 35-40. We are here right now. Stage 4. Sudden recognition. Something triggers the realization that valuations are unsustainable. Selling accelerates regardless of fundamentals. CAPE ratios collapse from 40+ to 15-20 within 18 to 36 months. This is what's coming in 2026. The last time we witnessed Stage 4 was 2002, when the S&P 500 fell 49% and the Nasdaq fell 78%. But that crash happened when household stock ownership was much lower, retirement account balances were smaller, and algorithmic trading was minimal. The structural vulnerabilities today are exponentially larger. Here's what most investors don't understand about CAPE 39. To justify current stock prices through future earnings growth, companies would need to increase profits by approximately 400% over the next decade while maintaining current profit margins. That's mathematically impossible given historical economic growth rates, demographic trends, and corporate profit margins already at record highs. Corporate profit margins in the S&P 500 are currently 12.8%, compared to a long-term average of 6.8%. This margin expansion has been driven primarily by share buybacks, financial engineering, and monopolistic market concentration, rather than genuine productivity gains. When recession hits, margins compress rapidly and earnings collapse by 30-50% in typical downturns. But the current setup is worse than typical recession scenarios because companies have used debt financing to fund share buybacks rather than productive investments. Corporate debt to GDP has increased from 45% in 2000 to 78% today. When earnings collapse and debt payments come due simultaneously, bankruptcy filings explode and equity values evaporate. The mathematical reality is even more stark when you examine sector-level valuations. The technology sector, which comprises approximately 30% of the S&P 500, trades at an average forward price-to-earnings ratio of 28.7. The historical average for technology stocks is 16.4. For tech stocks to justify current valuations, they would need to grow earnings at 25% annually for the next 5 years, while maintaining current profit margins. That's never happened in the history of financial markets. Meanwhile, the concentration of market capitalization in the largest companies has reached levels not seen since the 1960s. The top 5 companies in the S&P 500 now represent 24.8% of the total index value. When these companies face earnings disappointments or multiple compression, the entire index suffers disproportionate declines. This concentration creates systematic fragility that amplifies rather than dampens market volatility. But here's where the situation becomes truly terrifying. Unlike 2000, when the bubble was primarily concentrated in unprofitable internet startups, today's bubble encompasses the largest, most profitable companies in the world. Apple trades at 30 times earnings despite slowing iPhone sales and mature market penetration. Microsoft trades at 34 times earnings despite cloud competition and AI investment costs. These aren't speculative growth companies. These are supposed to be the stable core holdings of every retirement portfolio. The index fund revolution has created additional systematic vulnerabilities that didn't exist in 2000. Passive index investing now represents over 50% of all equity mutual fund assets. When markets decline, passive funds experience automatic outflows that force indiscriminate selling, regardless of individual company fundamentals. This creates feedback loops where declining prices trigger more outflows, which force more selling, which causes further price declines. Exchange-traded funds have grown from $66 billion in assets in $2,000 to over $8 trillion today. During market stress, ETF share prices can disconnect from underlying net asset values, creating arbitrage opportunities that further amplify volatility. The largest equity ETF, SPDR S&P 500, now holds over $400 billion in assets, larger than the entire mutual fund industry was in 1990. But perhaps most dangerous, target date retirement funds have automatically increased equity allocations for millions of workers approaching retirement. Unlike previous generations who reduced stock exposure as they aged, today's near retirees are more heavily invested in equities than any previous generation. When the market crashes, these workers won't have time to recover their losses before retirement. The demographic timing could not be worse. Approximately 10,000 baby boomers retire every day, and this rate will continue through 2030. These retirees will be forced to sell stocks to fund their living expenses regardless of market conditions. This creates structural selling pressure that compounds any cyclical market decline. Social Security and Medicare funding crises add additional systematic pressure. The Social Security Trust Fund is projected to be depleted by 2034, potentially forcing benefit cuts or massive tax increases. Medicare faces similar funding shortfalls. Retirees who experience major portfolio losses in their 60s will have no social safety net to cushion the impact. The current setup is a perfect storm of overvaluation, systematic fragility, demographic pressure, and fiscal constraints that could create the worst retirement crisis in American history. But the triggers for this crisis are already becoming visible for anyone who knows where to look. Corporate earnings growth has slowed to 2.1% year over year in the third quarter of 2025, despite massive share buyback programs and financial engineering. Revenue growth has decelerated to just 1.8% annually. These are not the growth rates that justify CAPE 39 valuations. When earnings growth turns negative in the next recession, the mathematical impossibility of current valuations will become undeniable. Interest rate sensitivity has also increased dramatically since 2000. Corporate debt loads are higher, consumer debt is higher, and government debt is higher. When the Federal Reserve is forced to raise rates to combat the next inflation surge, the entire debt structure becomes unsustainable simultaneously. Higher rates also make bonds competitive with stocks again, reducing the relative attractiveness of equity investments. Currency risks are accelerating as well. The U.S. dollar's reserve currency status is being challenged by China, Russia, and other nations developing alternative payment systems. If confidence in dollar stability wavers, foreign investors could reduce their massive holdings of U.S. stocks and bonds. International investors own approximately 40% of U.S. corporate equity, up from 15% in 1990. Geopolitical tensions are adding additional systematic risks that could trigger sudden capital flight. Trade wars, military conflicts, and technology decoupling all create uncertainties that historically cause investors to demand higher risk premiums. Current stock prices assume continued globalization and peaceful international relations, assumptions that are increasingly questionable. The artificial intelligence bubble is also creating sector-specific vulnerabilities that could spread to the broader market. AI companies represent approximately 15% of S&P 500 market capitalization, but their valuations depend on revenue growth projections that may prove impossible to achieve. When the AI bubble bursts, it will drag down the technology sector, which will drag down the overall index through concentration effects. Perhaps most concerning, market volatility has been artificially suppressed through algorithmic trading and central bank intervention for over a decade. The options market provides early warning signals that institutional investors are beginning to position for extreme downside scenarios. Put option volumes on major indices have increased 67% since September 2025. Volatility skew has shifted dramatically toward protective puts rather than speculative calls. These are not the positioning patterns of investors who believe current valuations are sustainable. Credit markets are also flashing warning signals. High-yield corporate bond spreads have widened despite continued economic expansion. Investment-grade corporate debt is trading at spreads that typically accompany recession concerns. Bank lending standards have tightened across all categories. These credit market signals typically lead equity market corrections by 3 to 6 months. International market performance is diverging sharply from U.S. markets, suggesting that global investors are becoming selective about where they deploy capital. European markets trade at CAPE ratios around 17 compared to U.S. markets at 39. Emerging markets trade at even larger discounts. This valuation gap is unsustainable and will eventually close through you as market declines rather than international market increases. The residential real estate market is providing additional systematic pressure. Home prices relative to incomes have reached levels that exceeded even the 2006 housing bubble peak. Mortgage rates have increased from 3% to over 7% in less than 3 years. Housing affordability has collapsed for first-time buyers, reducing household formation and consumer spending power. When home prices correct, household wealth effects will amplify any stock market decline. Consumer debt levels have reached record highs across all categories: credit cards, auto loans, student loans, and mortgages. The average American household carries over $6,000 in credit card debt at interest rates exceeding 20%. Auto loan delinquencies are rising despite continued employment growth. Student loan payments resumed in 2024 after a 3-year pause, reducing discretionary spending. These debt burdens leave consumers vulnerable to any economic slowdown. Business investment has stagnated despite record corporate profits and low borrowing costs for most of the past decade. Companies have prioritized share buybacks and dividend payments over research and development or capital expenditure. This short-term focus has boosted stock prices but undermined long-term growth potential. When the current business cycle ends, companies will lack the productive capacity needed for rapid recovery. Government fiscal capacity is more constrained than during previous market crises. Federal debt has increased from 60% of GDP in 2000 to over 120% today. Interest payments now consume over 15% of federal revenues, limiting the government's ability to provide fiscal stimulus during recessions. State and local governments are also more highly leveraged and have underfunded pension obligations that will require taxpayer support. The international monetary system is more fragile than most investors recognize. Central bank coordination, which was critical for managing the 2008 financial crisis, is breaking down due to geopolitical tensions. Currency volatility is increasing as different central banks pursue incompatible policies. Cross-border capital flows are becoming more volatile and unpredictable. When I examine all these factors together, CAPE 39 valuations, systematic fragilities, demographic pressures, debt burdens, geopolitical risks, and policy constraints, the mathematical conclusion is inescapable. The current market structure is unsustainable and will collapse with or without a specific trigger event. The only question is timing. Market bubbles can persist longer than rational analysis suggests because human psychology and institutional momentum can override mathematical logic temporarily, but mathematics eventually wins, and the larger the disconnect between prices and fundamentals, the more violent the eventual correction. Based on historical precedent and current systematic vulnerabilities, I estimate that the probability of a 50% plus market decline within the next 18 months exceeds 75%. The probability of a decline exceeding the 2000-2002 crash approaches 90% within 36 months. These are not normal market risk parameters. These are systematic crisis probabilities. The triggers could be numerous and varied. A major corporation bankruptcy, a banking crisis, a sovereign debt default, a currency crisis, a geopolitical shock, or simply the recognition that earnings cannot possibly justify current valuations. In highly overvalued markets, any negative surprise can trigger cascade selling that feeds on itself. The human cost will be devastating. Retirees will see their 401k balances cut in half or worse. Pension funds will become underfunded and require taxpayer bailouts. Insurance companies will face solvency crises. Universities will face endowment shortfalls. Charitable organizations will reduce services. The social and political consequences will persist for decades. So here's my question for you. When CAPE 39 valuations finally revert to historical means, when retirement portfolios are destroyed, when a generation of investors learns that trees don't grow to the sky, when mathematical reality finally overcomes narrative psychology, which side of that trade do you want to be on? The CAPE crisis isn't a prediction about the future. It's a mathematical inevitability based on the present. At CAPE 39, we're not in a bull market. We're in the final stage of the largest valuation bubble in human history. What comes next isn't a correction. It's a reckoning. The warning signs are flashing red. The mathematical impossibilities are obvious. The systematic vulnerabilities are unprecedented. The only question remaining is whether you'll recognize the pattern before everyone else does. This is not investment advice. This analysis is based on publicly available market data and historical precedent. Past market performance does not predict future results.